I'm Daniel Wolpe.
I'm Ann Ritz.
I'm Nate Robbins.
And I'm Alex Smith.
And today we're going to be speaking to you about the PolyOne Corporation. Some things we're going to be covering during this presentation is the company overview, the industry overview, the company's positioning and strategy, a risk analysis, and our valuation.
PolyOne was formed in 2000 from the merger of two polymer companies, the M.A. Hanna Company and the GR Company. Today, PolyOne has more than 60 manufacturing and distribution facilities and nearly 7,000 employees worldwide. PolyOne is a premier provider of specialized materials with more than 35,000 polymer solutions. PolyOne operates through 4 business segments based on product type, and the visual display shows percent of revenue by segment. Color additives and inks, 26%, specialty engineered materials, 18%, performance products and solutions, 21%, and distribution with 35%. Distribution is PolyOne's largest revenue creator.
The specialty chemicals industry is an extremely competitive industry. If you look at the radar chart represented on your right, you'll see a breakdown of our Porter's 5 forces analysis. As you can see, there's a major upstream advantage given to the buyers in this industry. The competitive atmosphere, along with the advantage to the buyers, can cut deeply into PolyOne's margins. Along with those, oil and natural gas price fluctuations can also cut into those margins. Some key sales drivers in the industry are pricing, quality, reliability, and availability. PolyOne has a highly diverse customer group. 58 of the disclosed customers represent 25% of PolyOne's total revenue. If you look at the pie chart on the right, you will see a breakdown of PolyOne's revenue by region. As you can see, the United States accounted for 56% of PolyOne's total revenue, giving PolyOne heavy exposure to the United States economy. PolyOne has a 5-year net margin average of 3.5%, which was lowest amongst all of PolyOne's competitors. These margins are heavily exposed to oil and natural gas prices, which can either increase or decrease that net margin. Patents are what help set companies apart within the industry. Currently, PolyOne has a total of 175 patents amongst its parent company, along with its subsidiaries, and 60 more pending currently within the United States.
PolyOne is actively looking for mergers and acquisitions with a good reputation in order to fit their Invest to Grow strategy. The Invest to Grow strategy focuses on safety, technology, geography, service, people, and financials. In the last 10 years, PolyOne has had 16 mergers and acquisitions, with one of their most recent, one of their larger ones being Fiberline Incorporation for $120 million in cash. This acquisition is expected to add $100 million in 2019 sales.
In our risk analysis, we looked at several different aspects from the industry, the U.S. economy, and the global economy as a whole. We're going to highlight 3 of those major points for you today in our presentation. First, oil and natural gas prices. Due to the nature of PolyOne's products, most of their products are derived from oil and natural gas derivatives. So that's going to affect their input costs, and it's also going to affect the energy costs for the manufacturing centers and their distribution centers. Next, industrial production. Since PolyOne is really heavily weighted in the United States, they're also heavily exposed to U.S. manufacturing. So we really need to pay attention to the Industrial Production Index within the United States. And as you can see in the top right-hand corner, that is the Industrial Production Index for the United States. And over the past few years, we've seen a steady incline in the industrial production. But as you can see, as of late, we've had a little bit of a dip. So any sustained stagnation or decline in the industrial production of the United States is going to really affect PolyOne's bottom line or the revenues. Lastly, interest rate increases. As all of you know, the Federal Reserve raised rates 4 times in 2018, and that's due to them trying to tighten the economy. And with a tightening economy, you're going to have less manufacturing production, you're going to have less consumer spending, and most importantly, what's going to affect PolyOne directly is since they have a double B credit rating by S&P, which is junk bond status, they're going to have trouble in the future dealing with higher interest rates and trying to roll over their long-term maturities. And as you can see in the bottom right-hand corner, we compared their average interest rate to the 12-month LIBOR rate. Next, valuation. So we use 3 different valuation methodologies: a bottom-up DCF, top-down DCF, and a Monte Carlo simulation. As you can see in the bottom left-hand corner, we have the weightings for each one of these methodologies. Both of the DCFs have a 12.5% weighting, and the Monte Carlo has a 75% weighting. The Monte Carlo has a 75% weighting due to having 50,000 simulations and having 3 stochastic variables. Those variables are revenue, cost of goods sold, and interest rates. Both revenue and cost of goods sold follows a normal distribution, and the interest rates follow a log normal distribution. In the bottom right-hand corner, we have the share price distribution from the Monte Carlo. Red signifies a sell, gold or yellow signifies a hold, and green signifies a buy. And just above that, you can see that we compared the Monte Carlo value, the Monte Carlo stock distribution versus the 52-week high and low for Polygon.
Being that the target price is a 29% premium over the current trading price, we actually perceive that to be at par if you price out the Q4 of 2018, which was really just discounting for Q1's earnings recession, which we are currently observing now. When you take a look at Q3's trading price, you can see 41.48 on the 5th of October. That was the last time that the trading price was near our target price, and so we perceive that as being an at par target price. A cause for concern for us in our analysis was their current capital management. Poly1's currently operating 3 different programs: share repurchasing, increasing their dividend payouts, and their invest to grow M&A strategy, which they look to do most of their acquisitions in cash. If you take a look over here on the far right, you can see the aggregated figures for those 3 programs spending. You can see from 2016 to 2017, they took a slight dip, but that dip kind of stagnated into 2018. What makes this really interesting is that they utilized their revolving credit facilities for the first time in fiscal year 2017, as you can see here, with a $60 million balance. In fiscal year 18, they doubled that balance to $120 million. This alludes to Poly1's short-term cash management problem for running these programs. Another cause for concern for us is 2 $600 million long-term principal maturities due in fiscal year 22 and fiscal year 26. Given that they have a BB rating by S&P, their rollover risk is considerably increased, as negotiating rollover on these maturities would produce higher interest income or interest expense. Given their current capital management, we believe it's unsustainable for long-term growth and could hurt their overall profitability in the future. If you take a look, though, at their distribution segment, there is some upside potential there. They have a well-established logistics infrastructure in emerging markets such as China. They also, in that logistics infrastructure, they sell the suite of Poly1 products and products from their competitors. A large firm such as an oil company could leverage this established logistics infrastructure to utilize to better facilitate their supply chains in emerging markets. So we believe there's an upside potential there. I'd like to reiterate the current trading price of $32.35 with our target price of $41.63, a premium of 29%, but we recommend Poly1 a hold.
I think, trying to go ahead.
Well, all I was going to say, it's a good presentation, but sitting here absorbing the presentation, I'm sensing just negativity. Just the price is not going to hit 41. I'm not questioning your conclusion at all by any stretch, but in my mind, I'm thinking they're going to have a rough time hitting that target price. They've got high debt already, relatively speaking. They've got a higher than LIBOR interest rate, which interest rates, my opinion, are only going to go up from here. When this money or these current debt starts to roll over, what kind of rate are they going to have to pay? And how is that going to affect their earnings? To go from 32 to 41, and answer, I guess this is the question rather than just spouting off here. It seems difficult to me that this company is going to be able to go from 32 to 41 with all of those negative constraints on profitability.
If I could speak to that for a second. The reason why we have the higher stock prices, you have the Q4 sell-off, and there's expected to be kind of like a rebound in the stock market. So, when everyone's down, you saw how Poly1 went down with the market. When the markets come back up and kind of rebound from this, as investors start to enter the market again, and they're not as afraid of interest rate hikes, since a lot of the talk coming out of the Fed is that they're going to wait and see how the market reacts before they start raising rates again. So I think that, we think that the price will go back up to its original position before the sell-off.
Could that be just wishful thinking? And,
Could be.
and, you know, an investor out there is gonna be looking for reasons to buy into it, getting back into the market. Let's say a lot of people bailed out somewhat. To get back in, they're gonna do somewhat of research, and it's not as in great depth as you guys did. But there's gonna be some research done, and if they hit all those negative points, high debt, double B rating, constraints on earnings, you didn't even touch at all on the environmental issues, if there are any with this company. I don't mean to sound hard.
No, you're.
It was like I said, you did a good job on the presentation. But I come from more of an investor background, individuals' money, invested. Would I buy this stock? These guys are the experts in the financial analysis part of it.
I'll just say, I think it must have been tough, if I were you, to have a conclusion of hold at the 29% upside, because 99% of that's a buy, too. So that must be a tough, so that's not a question. The question is, tell us a little more about the bottom-up DCF. You didn't really give us much detail on that.
Yeah, so on the bottom of DCF, kind of the methodology behind that was building my schedule. I built the bottom of DCF, was building my schedules from each line item. If you take a look at the balance sheet, the main balance sheet was derived from building out each schedule individually, either logically growing them with revenue or their other logical counterpart, depending on what line item that we're looking at. When I did the debt scheduling, I basically looked at just principal maturities. Most of that was because when we look at the cash flow statement, I don't match their cash flow. I bucketed it to a pretty standard cash flow statement. So I just had scheduled out their principal maturities in terms of the cash flow. Kind of ran into some snags on the debt in general, and that's what kind of got us to that point where we were talking about the capital management, just in terms of scanning through the 10K, just the way they run their debt was very interesting. So that was when I built the debt schedule for there. Basically, the difference between the top down and the bottom up is he built certain supporting schedules, the important supporting schedules, whereas I went through every line item and tried to forecast.
Yeah, I would just say that I really appreciate your focus on this aspect, the debt aspect, the capital management aspect. It's forward-looking, that's excellent. I think, it's just, a judge wants to see assumptions that drive the valuation, and they want to see how you got to the assumptions. So the assumptions are things like growth rates, discount rates, margins. So we want to be able to see that. We want to be able to understand that we believe or not believe, and you thought of it. And I would have liked to have seen you show us that.
Yeah, I can kind of speak to that a little bit. That was my big snag when building that model, was kind of trying to grow the revolving credit or kind of project out their debt and how they would debt structure in the future. And that was my biggest snag in the model. And that's what kind of derived. I ended up leaving it out because I really did run into some issues when it came to forecasting that. And that's why I kind of called to it here in the presentation now.
Yeah, I'll reiterate, I do like this information here, especially to talk about the credit rating. I think it's important as equity investors to look at the complete capital stack. So how do the credit markets view the company? One question I have is, what led to the decision to run select Monte Carlo as a valuation methodology?
I built the Monte Carlo. It's just an extension of the top-down DCF, so it's a 5-year top-down DCF. And then we just picked 3 variables that are really important to the DCF, which would be the revenue, cost of goods sold, and especially interest rates with the environment that we're seeing today. Monte Carlo is just used as a precision thing, so that's why we weighted it heavily, because we ran 50,000 simulations with 3 different distributions of those variables, kind of showing the variability of what could happen with their stock price, given if interest rates change to different levels, if their revenues see different growth rates, stuff like that.
So this most recent acquisition, it was just done a month or 2 ago. It's why don't you put that? Yeah, it's much larger than anything in the past, except for way back in 2011. What do you guys? If I'm the PM and you're my analyst and I buy the stock, what are you going to be monitoring? What metrics are you going to be monitoring to determine whether this is a good or a bad acquisition?
Me to speak to it, or you to speak to it?
I can speak for it for a little bit. The CEO, Robert and Pattinson, said that Fiberline would be a great investment for their specialty engineered materials segment. and this segment does have the least percent of revenue coming in right now, so that could be one of the main reasons why they made this acquisition.
The Fiberline company itself is very centered in 5G technologies and providing solutions for the developing 5G infrastructure. So I believe when they made this acquisition, they thought they would pony up the capital for it to try and get on the 5G growth trends and try and get into there. Especially given the current environment with Huawei, now the US is gonna have to come out with their own 5G infrastructure. This could play out fairly well for Portland.
So that's a great qualitative answer. Does that, from the financial side, does it lead into your conclusion about sort of your concern about the forward-looking kind of financials, the size, and
It's just the sustainability of doing stuff like this. So doing all three of those programs that we were talking about, how sustainable is that in the long run? Because it seems like they're trying to grow by acquiring companies and doing strategic positioning and technologies like 5G, stuff like that. So we really want to be looking at kind of like how are they going to structure that going forward? And it looks like it's not very good because they're pulling out their credit facilities. They have a lot of maturities coming up. Their credit rating isn't good. All of those reasons is why we view it as being unsustainable financially.
Have you done any kind of, I don't know the answer to this, but just the Monte Carlo method in general? Have you looked back and studied anything at all on how successful the Monte Carlo simulations are in predicting the future activity?
No, the thing about Monte Carlos is everything is just probabilities there. So you use, with Monte Carlo, obviously you're going to use random probabilities to select each one of those simulations. And Monte Carlo isn't amazing at predicting the future, but it can show you if you put in the right assumptions, depending on what your assumptions are, which we assumed that interest rates were going to be higher. So we put the mean interest rate at 5.5%, which is higher than what they have now. And that's assuming that the Federal Reserve is going to be forced to raise the rates and stuff like that. So Monte Carlo, the thing about Monte Carlo is it's more of like an art form because you have to get your assumptions really, really, really down. And that's the biggest problem.
The reason I asked that is you've got 75% weighting. That's pretty high.
Yes. Yeah.
So it's not bad.
how did you pick the three variables that you picked?
So when I did my top-down DCF, I did most everything is based off of revenue. So everything in the income statement is going to be based off of some percentage of revenue. So revenue is obviously going to be important. Cost of goods sold, that's really important as well because as we talk about with the oil and natural gas prices, then those costs being variable over the long term, especially seeing that oil dropped dramatically in the fall, maybe seeing a rise and that could change their cost of goods sold significantly in the future. And then interest rates, we chose interest rates obviously because we're in a kind of volatile interest rate market right now. So with all the raising of rates, you're gonna have a lot of different changes going on there, especially with their debt interest rates going up. That's why we chose a higher mean than what is current right now.
That's your time. Thanks, guys.
Thank you.
Thank you.